Hello and welcome. So we are going to discuss chapter 5 now. So in this thing we are going to discuss consumer credit. So background before starting the class. So let's say I go to a shop and I buy this iPhone. So this is iPhone 10. So I go to the shop and buy iPhone 10. How can I buy that iPhone 10? One option, the traditional option, you can buy that iPhone 10 in cash. So you save for buying something. Once you have that money, you go to the shop and you buy that thing. Okay, this is the traditional way. Or I can take that phone on credit. So there are two ways I can buy this iPhone 10 on credit. One is consumer loans. Consumer loan is I go to the shop, I buy this iPhone 10, let's say it is costing $1,500. So instead of paying $1,500 right away, I pay $1,500 in payments. So every month or every bi-week or every week, I pay certain amount towards this phone. So instead of paying 1,500 upfront, I'm paying 1,500 in a staggered way. Of course, this will not be for free. They would charge me certain interest rates for providing me this function. The third type is I can buy this phone on a revolving credit. Revolving credit is I I pay for it on my credit card. So I swipe my credit card for $1,500. Do I pay right away? No, I don't pay right away. But I get that phone right away. So $1,500 is a credit that is extended to me by my bank or my credit card company. Now, after a certain period, let's say 30 days, when my bill is due, I would have to pay that 1500. I can pay that entire $1,500 and get that phone. So I get an 30-day period to pay my $1,500. Or if I don't pay $1,500, I pay lesser amount, then they would charge interest on the amount that I'm not paying. So let's say instead of paying 1,500, I only pay $500 towards my credit card bill. Rest of the $1,000 they would charge fees and interest on it. Okay, so you can buy stuff either in cash or in credit. In credit, you can buy it through consumer loans or you can buy it in revolving credit. Revolving credit is nothing but credit card. Consumer loans is payment cycles or payment installment loans. So we are going to discuss consumer credit into it. So what is consumer credit? Credit is an arrangement to receive cash, goods or services now and pay for them in future. Consumer credit is used of credit for personal needs except for home mortgages. So instead of means rather than buying house, you can buy electronics or certain other stuff. There are three ways consumer can finance current account purchases. So take money from savings, pay in cash, use present earnings, or borrow against expected future earnings. So you can use your savings, you can use your current earnings, that is your checking account, or you can use future earnings, that is borrow. Trade-offs are involved in using credit. So before you use credit for major purchases, ask yourself some questions. Could I pay cash or make a down payment to reduce my loan? Do I want to use savings for this purpose? Does purchase fit with my goals and budget? Am I getting overboard? Am I buying something that is not needed? Could I use the credit I need for this purchase in some better way? Could I postpone this purchase until I have enough savings to buy it in cash? What are the opportunity costs for postponing this purchase? So let's say I want to buy a car. What is opportunity cost of buying a car? The convenience, the savings of time, the let's say it's a winter season, so the physical difficulties I'll go through when I'm using public transport rather than using my own car. So these are the opportunity cost. What are the dollar and psychological cost of using credit for this purchase? Am I comfortable with credit? Can I make those payments? If I don't make those payments, what would happen to my psychological well being? So, all this you have to consider when making a major purchase. There are certain advantages of credit. Current use of goods and services. So, you can use goods and services and pay for them later. Permit purchase even when funds are low. Use for financial emergencies. So credit cards help a lot when there is a financial emergency. Example, I was hiking long time back in the Himalayas in northern India near the Indo-China border, and it was a quite a remote location, and I was not carrying major cash on me. So one of our friends, one of my colleagues who was hiking with me, had an accident. So we had to rush him to a local hospital. So neither he was having cash on him, neither I was having cash on him or cash on me. But we both had credit cards. So in such cases, it can be used for emergency purposes. Convenient when shopping. It is very convenient to use cards while shopping, safer than cash. You can take advantage of 30 days float. So if you pay your credit card bills on time, they don't charge you any interest. So it's like using credit for free. May get rebate, airline miles, emergency medical insurance, and other bonuses. And you demonstrate financial stability. So you build your credit ratings. So if you don't use credit at all, that's also a problem, because when you take housing loans and all those things, you have to have the credit reports, you have to have your credit rating. So credit rating or credit report doesn't get built until you use credit. So it is important to use credit also, but you have to use credit very carefully. Disadvantage of using consumer credit: you purchases are more expensive. So this happens many times. You go to a shop to buy iPhone 7, but you don't have to pay for that iPhone 7 right away. You can get into payment plans. So instead of paying getting an iPhone 7, you buy an iPhone 10. So this happens. It happens to me too. Temptation to overspend ties up future income. So your future income is reduced because because of your payment plans. Possibility of financial difficulties, damage to family relationship, and slows progress to future goals. So types of credits are: first type is consumer loans, one time loan that borrower pays back in a specified period of time with a predetermined payment schedule. Home mortgages, automobile, and household furnishing are generally taken on consumer loans. Example is installment plans. So you buy certain thing. Let's say I buy a furniture. I buy a sofa or a couch for my living room. So instead of paying for it upfront, I pay for it monthly or bi-weekly. That's a consumer loan. Revolving credit, a line of credit in which loans are made on a continuous basis and borrower is billed periodically for at least partial payment. Department stores or bank credit card. So you can buy stuff but you're billed monthly. And if you pay for the entire bill, you're not charged interest, but if you don't pay entire bill, then you are charged interest on amount left or amount outstanding. Examples of consumer loans: housing loans, automobile loans, consumer installment loans, demand loans. Revolving credit, credit cards, change cards or travel and entertainment cards. American Express is an travel, means it's a diners club card. Line of credit and overdraft protection. Okay, so I'll explain each one of them. Housing loan, it's very evident. So you buy a house, you take a big housing loan and you pay EMIs. Automobile loans, you buy a car and you pay installments on it. Consumer installment loans, like you buy a TV or etc. and you take loans. Demand loans are similar to consumer installment loans. So Those are things. Revolving credit includes credit cards issued by banks, so they have a tie-up with Visa, or store cards like a Costco card or a Canadian Tire card. The famous example is Ford, the card that Ford invented, or Walmart cards. Change card or travel cards are very similar to credit cards. Only thing is you have to pay the entire amount. There is no option of paying minimum amount. So you have to pay the entire amount that is due. Line of credits that are open to you. So you can take a student loan based on a line of credit. So amount you use towards your education, only you are charged interest on that. You are not charged interest on the entire amount. Overdraft protection. So this is also an example of credit card. So revolving credit limit, the dollar amount which may or may not be borrowed that a lender makes available to you. For example, I open a credit card and they give me $3,000 of credit. So I will not be charged on this amount that is extended to me. I will be charged on amount that I actually use. Interest, a periodic charge for use of credit. A personal line of credit, a pre-arranged loan from bank for a maximum specified amount. Important point, you are not charged on pre-arranged loans. You are charged on amount you actually use. Following points can describe the credit card user scenario. Nearly 89% of Canadian households carry one or more credit cards. 56% of all credit card users are convenience users, so they pay their balance of each month. So this is very important. So you pay off your balances. Other 44% are borrowers. Co-branding, linking a credit card with business offering rebates and product and service. So this is means all of us has experience. You get certain points on shopping. So you can either have travel points, you can have cashbacks, or you can have certain other points like scene cards that you can use for watching movies. So whenever you shop, you can get certain points. Smart cards have embedded computer chips. Most of the times right now we have smart cards. Choosing a credit card. So when choosing a credit card, it pays to shop around. Follow these suggestions to select a credit card that best meets your requirement. Department store and gasoline companies are good places to obtain your first credit card because they are not as stringent as banks. Pay your bills in full on time to avoid interest charge of 28% and higher, and you will begin to establish a good credit history. So this is important. Bank cards are offered through banks and credit unions. The interest rate is little lower than the department cards, around 21 8 to 21%. So it is significantly different. So shop around. If you usually pay your credit card bill in full, try to deal with financial institutions with an interest free grace period, which is the time after the purchase that you are not changing. Most of the credit cards have interest free grace period. So when you shop until you get the bill, they don't charge any interest on it. If you are used to paying monthly installment, look for a card with lower monthly fees. Consider obtaining a card from out of province financial institutions because sometimes the provincial laws are different and the provincial offerings are different, so you may get a better offering at out of province. Be aware of some cards that offer no fee or low interest but start charging interest from day you purchase item. So they may not have a monthly fee but they don't have a grace period. So always read the fine print before subscribing to a credit card. Watch out for credit cards that do not charge annual fees but instead a transaction fee each time you use. If you are paying only minimum accounts on your monthly statement, you need to plan your budget carefully because you will be paying a lot of money. The longer it takes to pay off your bill, the more interest you pay. With grace period of 25 days, you actually get a free loan for 25 days, so use it to the maximum. To avoid delays that may result in finance charges, follow the credit issue restrictions. Beware of offers of easy credit. No one can guarantee to get you credit. Be beware of credit cards offered by credit repair companies and credit clinics. These firms may offer to clean up your credit history, but no one can, there is no free lunch. If you have a bad credit history, it will take time to repair it. No one can do some magic trick to repair it right away. If you do not have a list of credit issuers' telephone numbers, you will be able to obtain them online. Travel and entertainment cards often charge higher annual fees than most cards. Usually, you must make full payment within 30 days. Often, additional credit cards on your account for spouse and childs are available. Beware that debit cards are not credit cards, but simply they substitute check and cash amounts. Here are the cost and benefits of credit cards. Benefit is short term no interest loan if paid in full. Rewards, rebates, and points. You get a lot of rewards and points based on your purchases. Insurance on purchases, because you can stop payment. If I don't like the goods, I can stop payment and then resolve it with the shop that I have bought the good from. Protection against fraudulent use. So this is important. Legally, you are not liable to pay more than $50 if your credit card is stolen. If there is a fraud on your credit card, you are not liable to pay more than $50. So if my credit card is stolen and someone uses it, I'm not liable to pay more than $50. But most of the companies have their own policies, so you're not liable to pay anything. Okay, legally it is $50, but most of the companies like Visa and MasterCard cover all your, means cover all the frauds. So I'm not even required to pay that $50 most of the times. Availability of credit card in case of emergency, this is a big thing. Cost, late and overdue payment, charges for exceeding credit limits, cash advances. This is a very bad idea. If you take cash advances on your credit card, you are charged a one time fee, then you are charged interest on that cash advances, and these are very expensive loans. So try avoid doing that. Transactions in foreign currency and exchange rate loading fees. So these are significant fees, and membership fees. These are the, okay. So I clicked something. Steps to follow when credit card is stolen. Call them up immediately, cancel the stolen card, ask for a new account number. A new account number is generally sent to you by mail. Carefully check your future credit card statement for purchases you didn't make, because you have to get back if any fraud is made. And these days most of the banks provide you real time transactions on credit card, so there is no blackout period. Earlier there was a blackout period, so you were using your credit card but you did not know where your credit card has been used till you get the monthly statement. But nowadays most of the bank gives real time information, so do check if your bank is providing real time credit card information, transaction information. If you find any charges that aren't yours, call a toll free number and inform them right away. Protecting yourself against debit and credit card identity fraud. Phone scams are an attempt to gather information or payment from you by pretending to be someone. A recent scam, they can call you stating that you are CRA, that they are CRA and they are seizing your property, or they can call you stating that they are from immigration if you are a foreign student or a foreign worker. So, phishing is an attempt to attain sensitive information by posing as a reliable source. So, be very careful. You're not supposed to disclose any personal information on phone. Protecting yourself against debit card farming is when you are redirected to bogus websites even if you can enter the correct information in initial search. So it's because of computer virus. So have good antivirus software is installed in your computer. Shoulder surfing occurs when someone sees your pin over your shoulder. Dumpster diving is when personal information is gathered by looking at your trash. Skimming occurs when thief steals information on magnetic strips of your credit card by swiping through a small machine. So there were card duplication machines. So if you swipe a credit card, though the information on the magnetic stripe was recorded, and they can duplicate your credit card or debit card. So chips came in, but right now there are softwares that can scan your chips too. So chips are better than magnetic stripes, but they are not very secure. They are not means 100% secure too. There are chip reading mechanisms. Sign new cards as soon as they arrive. Treat cards like money, keep them secured. Shred anything with your account number on it. Don't give your number over phone unless you initiate the call. Get your card and a receipt after every transaction and compare them to bill. Immediately report if it is stolen. Notify issuer if you have error on billing statement. Check your credit report every few years. You have to check your credit report because there would be individuals that have asked credit on your behalf. So it can happen. So you every few years you have to check your credit reports. So we'll talk about credit reports in the next class, but in the next session. But you have to check your credit reports every few years. If you make purchases online, use a secure browser, keep your records, review monthly statements, read policies of websites, keep your personal information private, give payment information only to businesses you know, never give your password to anyone online, don't download files sent by strangers. Features of personal line of credit, revolving line of credit, interest rate linked to lender's prime rate. Okay, what is line of credit? You get a pre-approved loan or a pre-approved card, and you can use that money. Whatever you use, you pay interest on it. Interest rates are linked to lenders prime rate. So prime rate is something that government of Canada decides, and interest rates are based on that prime rate. So if interest rate goes up, the borrowing rate goes up. If interest rate goes down, the borrowing rate goes down. Withdraw up to a specified limit, repay minimum stated or more, and secured, it can be secured with assets like GIC or home equity. So home equity is the biggest means the large proportion of predetermined credit loans are home equity loans. So what is home equity loan? So I have an apartment that is currently around 400,000, and I have a loan on it of around 300,000. So what is my home equity? Home equity is the value of my house minus value of my loan. So 100,000 will be my home equity. So I can borrow against this home equity. Can I borrow 100%? No. So I can borrow only 65% of my home equity. So a loan based on current market value of your home less the amount you own on my mortgage, you can borrow up to 65%. Interest on loan is tax deductible if proceeds are being used for investments. Usually set up as a revolving line of credit. So the amount you use, you're charged on it, not the amount that they have approved for you. Consumer loans, mortgage loans, the biggest single debt most Canadians will incur. We will discuss consumer loans in chapter 7 because it's important. They have dedicated an entire chapter towards it. Car loans, automobile is your second largest investment after your house. Financing can be done through bank and at dealer. So required to make minimum down payment. Balanced finance in installment loan at fixed or variable rate, often with open prepayment costs. So you can prepay that loan and close the loan. Financing is available at dealers, also affiliated with manufacturers or financial institutions. Significantly lower interest rates on some models, and other incentives can be there, like free winter tires if you take financing through the dealer rather than through a bank, etc. Car loans can be close-ended lease. You can buy the vehicle at the end of the lease or return it to the company, or open-ended when you're responsible for residual value of the vehicle at the lease. Vehicles, so you can lease the vehicles too, either an close-ended lease where you buy the vehicle at the end, or open-ended lease where you return back the vehicle but you're responsible for the residual amount. Vehicles are owned by leasing companies. You pay maintenance, repair, and insurance, and may have mileage restrictions. Paying cash, avoid interest charges. However, investment returns may be higher than cost of borrowing. Before you take out a loan, ask yourself, can you afford the loan? What do you plan to give up in order to make payments? First, learn how to make an accurate and sensible family and investment budget, and then take on loan. So the next is credit capacity, measuring how much credit can you take, how much loan can you take. So first is debt payment to income ratio. So whatever monthly payments you make on your debt and divided by your monthly income. So experts suggest that it should not be more than 20%. So not more than 20% of your income should go towards furnishing debt. But doesn't include housing. These are two extremely important ratios. This we'll discuss again in chapter 7 when we discuss housing. GDS and TDS ratios are used by financial institutions to check how much loan, how much mortgage, specifically home mortgage, can you take. Okay. GDS is your monthly mortgage payment, including principal, interest, heating, and taxes as a percentage of your monthly gross income. So, what do you do? Amount you pay on your loan plus amount you pay on your utilities, specifically heating, and the taxes and interest, all combined, divided by your monthly gross income. Now, banks use a criteria that this should not be more than 32% of your gross income. So let's say I'm applying for a loan that is going to have my monthly payment as $1,500, right? So $1,500, that includes interest and principal, plus the heating I pay on that house, plus any other fees that are there, as well as interest on that house, divided by my monthly salary. Let's say my monthly salary is $5,000, gross pay is $5,000. So 1,500 plus all of that divided by 5,000. It should not be more than 32%. TDS is another thing. So gross debt service ratio and total debt service ratio. So the total debt service ratio is your monthly mortgage payment, including payments on outstanding debt as a percentage of your. So TDS considers all your debt, GDS considers only housing debt. So the amount lender will allow you to spend on shelter and non-sheltered financial obligations should not exceed 40%. So GDS, you consider only debt payments on your mortgage, on your house, and in TDS you consider debt payments, all debt payments. So like example, I bought a TV, so debt payment on that, debt payment on my car, etc. GDS should not be more than 32 and TDS should not be more than 40%. Next is co-signing a loan, guaranteeing a debt. Now this is a bit tricky. Sometimes your family and friends asks you to co-sign a loan, but you have to be very careful before co-signing. When you co-sign, you are taking on a liability that if the person doesn't pay, you would have to pay on his behalf. That is one thing. So be extremely careful while co-signing. Second thing, whatever loans you co-sign, they are reflected on your credit report, on your credit history. So your credit ratings may go down because of co-signing of loans. So you have to be careful. Guaranteeing a debt. If a borrower doesn't pay the debt, you will have to pay, including fees and collection costs. Statistics show that 3 out of 4 co-signers generally have to pay. If you do co-sign, be sure you can afford to pay. Liquidity can keep you from getting another credit. Liability can keep you from getting another credit because it shows on your credit report. Could lose the property you pledge as security. Understand the provincial laws and request copy of all due notices. Building and maintaining your credit expenses or experiences or lack of it is a major consideration for a creditor. A good credit rating is an asset. Use your credit at discretion. Limit borrowing to your capacity to repay. So rules: less than 40% of your monthly payment, total debt obligations. Abide by terms of lending contract. So do not have outstanding balances. Always pay your balances on your credit card, on any loans, because it shows in your credit ratings. The credit bureau is a reporting agency that collects credit and other information about consumers and sells the um, data to creditors to help evaluate applications. Your credit file includes your employer and position, your former address and your former employer, spouse name, social insurance and employers, public records and information. This is major thing. If your checks are returned due to insufficient funds, those show up in your credit reports. So credit bureau regulation includes the following. Most provinces have legal legislation to protect consumer privacy. So apart from your financial information, your personal information, your character information cannot be shown in those reports. Right not to suffer from false credit and so if there is any error in your credit history or in your credit report, you have a right to not suffer from it. So if you have suffered, you can have legal provisions to undo it. Others may only view your file if written consent has been given. First bankruptcy runs in your file for 7 years. Second bankruptcy results in both on your records for 14 years. So if you file for bankruptcy, then it is shown in your credit report for 7 years and then it is removed. Errors in your credit file should be corrected immediately. Credit scoring is used to assess the credit risk of prospective borrowers. Data in credit report is summarized in credit score. Credit scores help you to predict credit worthiness. Higher the score, better it is. So we generally have a range of 300 to 900 points. Anything above 600 is considered good. So if your credit rating is above 600, you are considered good. Higher the better. A strong credit score will help you get credit faster and at an advantageous rate. Following categories are weighted in your credit score. So payment histories, length of credit history. So how long have you been taking credit? Are you your credit behavior? How are you paying your credits? Amount you owe, types of credit used. So do you take more consumer credit or do you take more home mortgages and etc. Number of recent applications for credit. Even if you don't take credit but people are inquiring for your credit history, then that is shown in your credit file. More number of inquiries, lesser is the credit score, so it affects credit scores in a negative way. Improve your score by managing your debt responsibility. To obtain a copy of your credit score, you can go to Equifax. Did you know consumers are given one of the following ratings? So these are the rating mechanisms. RO too new to rate. So you can just read through. These are the different meanings. Creditors cannot legally consider. Okay, this is very important. If someone denies you credit because of these reasons, you can sue them. You cannot be denied credit because of your race. You cannot be denied credit because of your color, by your age, by your gender, sexual orientation, as well as marital status, because all of this is personal. So these are 5 C's of what banks look at while giving you credit: your character, borrower's attitude towards credit obligations, capacity, financial ability to meet credit obligation, capital, your assets that you have, collateral, valuable assets that is placed to ensure loan payments, and condition, the general economic conditions in the market, and the kind of job you're working, and would it be impacted by the economic conditions in the market. So beacon on FICO scores, that is what we generally use. This is a score between 300 to 900 of. It rates how risky your borrower are. 35% is based on payment history. So make your payments on time. The utility payments, because if you skip payments, it shows your phone payments, your credit card payments, your loan payments. Always make it on time. 30% is based on the amount owned on outstanding credit. So 15% is the time that credit has been maintained, and 20% on other factors. So if you want to improve your credit scores, what you have to do, you have to make your payments on time always. Second thing that you have to do, this is tricky, you have to have credit. So if you don't have a credit card, your credit score doesn't improve. So ideally you should have two credit cards, because two credit cards gives you a little edge. If you have one credit card, even then your credit uh, suffers. So ideally you should have two credit cards. Then 15% of the time the credit has been maintained. So you're not going overboard, you're not using 100% of credit that is available to you. So all that factors are important. So vantage scores, recent transactions you have taken, payment histories, credit use, credit balances, depth of credit, and available credit, all these, how they calculate the scores. They assign you letters. So you are super prime, prime plus, prime, or non-prime, etc. How can I improve my credit score? Age, a creditor may not turn down or decrease your credit because of your age. Ignore your retirement income. So your retirement income has to be considered when you apply for loans. Close your credit account or require you to reapply for it because you have reached a certain age. Deny you credit because of credit life insurance or etc. You may be denied credit because you receive old age security. So if this happens, you can sue them, because they cannot deny you credit based on your age, or your because you're retired, or because you get old age security. What if your application is denied? Ask questions why it is denied. If based on your credit report, ask what specific credit report led to the denial. Check with credit bureau to find out information that has been reported. Investigate and correct inaccurate. Improve your credit score, pay bills on time, don't exceed credit limit, and use credit wisely. In case of billing errors, contact creditors first to correct errors. Contact the fraud department of major credit bureaus. Contact creditors for amounts that have been tampered. File a police report. Close all bank accounts immediately and cancel credit cards. How do you resolve? So make a phone call to credit bureaus, then you can submit a letter to them. There are other alternatives too, you can just read through it, it's self-explanatory. So read this, pause the video and read this thing, read this, the how what you have to mention in the letter. and other alternatives. So what have we discussed? So credit is important. So first you have to decide, is borrowing money to obtain goods and services for personal need required? Advantages are certain things: purchase goods when you need them, ability to deal with financial emergency, convenience, establish a credit rating. But credit costs money, encourages overspending, ties up your future income. We have seen close ended, installment credit, and revolving credit. Close ended means you use credit and you pay installment. You buy certain things and you pay installment on it. Open ended means you have a credit limit, whatever you use you pay interest on it. Debt payment to income ratio, debt to equity ratio, and these are the certain ratios. The 5 C's: character, capacity, capital, collateral, and conditions. If any error is there, go back right away. So thank you. We'll continue in the next class.